and Sensex, where you did not have to take any risk. You did not have to track. You did not have to do anything. Just invest a lakh and you would have given. There are some direct stocks. For example, Wipro, IOC, ITC, TCS. These are all big companies. They would have given less than a Nifty index. Just consider it as a basket with, for example, different kinds of fruits. Why index funds? Why at all this topic? Why at all this video? And that's an important question, which once upon a time even I had. So, should you invest in a large cap mutual fund that is an actively managed fund, or should you invest in a large cap index fund? In my previous videos, I talked about large cap equities, large cap mutual funds. Now, they are the most important part of anyone's portfolio. Large cap equities, whether you directly buy from the market, that is direct investing in stocks, or you invest in mutual funds. It's a must. So before we get into a little details on the index funds, which is the topic of today's video, let me just quickly recap why large cap index, why large cap funds at all. So if you watch some of my previous videos, which I'm talking about asset allocation, and within asset allocation, how important a large cap equity plays. Large cap equities, in a nutshell, are the big companies in our country, the companies that produce a lot of goods and services which contribute majorly to the GDP, to the GDP of our country. They are large companies. Most of us, we all have some products or the other from these large cap companies. For example, Hindustan Unilever, the soaps that we use, the toothpaste, right? And the cleaning the floors or taking bath, or some of the big large cap companies like HDFC Bank, SBI. We all transact in banks. We go and fill petrol, Indian Oil, and then Reliance Industries, then Tata Motors. So these are all big companies, large cap companies, which impact our lives on a daily basis. So when you invest in a large cap equity, you are a part of that business. You're a co-owner of that business with a small share. And when you are part of a large cap equity, you're a part of the growth story of our country. The growth of our country depends on other mid cap, small cap companies and many other services, which are probably not listed, which are not listed. But large cap plays a major role in the growth of a country. And if you are invested in a large cap, and that is what I talked about in my previous videos, it's a must. It's a no-brainer. Large cap equities are companies which are global, which are market leaders, which pay dividend, which are stable, which give you good returns with less risk, and they are the most important part of anyone's portfolio. However big, however small, whatever is your age, however whatever is your risk profile, you must have it as a core portfolio. A core of your portfolio must include large cap equity shares. Now it all depends whether you want to go directly buy equity shares or mutual funds. And obviously, I talked about it even in my last video. Large cap equities, direct investing is risky, and you may end up buying the wrong stocks, which may not give you good growth, although they are all important, but there are some which grow at a very fast pace. So buying a mutual fund is way better if you are a busy professional and if you don't have time. And I said that focus more on your career, your personal development, your marriage, your children, your health and community service rather than investing directly. Of course, that is my opinion. Many of you may not agree, and many of those who invest directly may not agree. But this is what is my philosophy. Focus more on the important things of life. And that is what I said. You must invest in large cap mutual funds, and they should form a part of your core portfolio. Now, if you are a young family, definitely you must have a part of your portfolio large cap equities, large cap mutual funds, and index funds. I'll talk about index funds because number one, you must have equities in your portfolio. Equities are the engine for the growth of your investments. So you must have, and having large cap brings you that stability. Of course, you must have other mid caps, small caps, which we'll talk in a later video. But having large caps is important for stability, okay, and for returns, for good returns at low risk. So you must have as a young family, if you're watching, if you're in your 30s or early 40s, you must buy large cap mutual funds. Even if you are retiring or if you're retired, however is your risk profile, maybe you don't want to take a huge risk, low risk, you must have some large cap indexes. You must have exposure to large cap equities, especially large cap indexes. So you must have. So what I want to try to say here is that large cap equities, mutual funds, indexes, or even ETFs should form a part of your portfolio. Now, we can directly invest or you can invest in mutual funds. I talked about mutual funds in some of my videos. I've emphasized mutual funds. Then what? Why index funds? Why at all this topic? Why at all this video? So index funds are passively managed funds as opposed to mutual funds, which are actively managed. And in my last video, I talked about large cap mutual funds and I'd shared with you the performances of mutual funds. So why this video? And that's an important question, which once upon a time, even I had. And why it is an important, and this is what I'm going to explain to you. So let's take a look at one of the articles, a news item, which actually helps us understand this. For example, here's an article which came in May 15th, 2024 in Economic Times. It says, Unlucky 7. 88% large cap mutual funds failed to beat benchmarks in 7 years. So here there are funds. These are underperformers in 7 years. You've got all the top Axis Blue Chip, Aditya, Bandhan. So these are all the funds. The benchmark return is around 14.33 or 14.71, depending on whether it is a BSE or an Nifty, BSE Sensex or Nifty. So here you see that there are so many funds which have given performance less. So if it is 14.33, 14.71, they have given 12.48, 13.88, 14, 14.33, almost the same, and even 12.71. So 11.67, 10.81. So this article tells that there are most funds that have not done well compared to the index. And we will talk about index. Canara Robeco has not done well. SBI Blue Chip has given 12.77. So there are outperformers also. For example, Baroda, BNB Paribas, ICICI Pru, and Nippon India. These funds have given slightly better than the index. Let me share you another article. So this article says over half of Indian equity large cap funds underperformed their benchmark in 2023. So this is an article from March 29th to 2024, which is around 5 months from today, 5 months prior to today. So here there are over half of the Indian equity large cap funds failed to outperform the S&P BSE 100 index. And despite a strong year for the Indian stock market, according to a new report, a report by S&P Dow Jones Indices raises questions about the effectiveness of actively managed funds in India. The S&P indices versus active funds India scorecard for 2023 revealed that a significant portion of the actively managed funds underperformed their respective benchmark across various categories. We'll also take a look at the value research report, which I have pulled just now, and it is in Excel form. Let's take a look at how are the large cap indexes stacked against large cap funds. So this Excel includes all the large cap funds, including the active funds and the index funds. So if you look at the 3 years returns, so which is a top fund in the 3-year category? It is UTI Nifty 200 Momentum. So this is a kind of index fund. Then you've got Nippon India and Quant Focus, but then most of the funds which are in yellow are all the index funds. Sorry, they're all next 50 index funds. Then comes again 3 large cap mutual funds. But again, after that, you've got equal weight index funds. And see the difference. So here you got 23.69, not too far, not too less. In fact, Momentum Index Fund has given 25.91, highest, which is an index fund. And then you've got the equal weighted. And then again, a lot of the mutual funds which are in blue, these are actively managed, are here. See the return, 17 and 18. But index funds have given you 23% on an average. And then a lot of the other large cap. Here you have the normal large cap indexes, which is Nifty 50 or Sensex, and they have given good returns, 15.57. They've even done better than LICMF or Mirai or PGIM or Axis Blue Chip. Now, these are the Sensex, BSE Sensex, which follow the Sensex. Can you see? If you had invested 3 years ago in Axis Blue Chip, which was among the top funds in 2021, you would be at the bottom. And Index funds would have been the top. So index funds have done better, have done very well. Let's take the 5-year category. In the 5-year category, we've got quant focus, but again, you've got next 50 funds doing better than even a Nippon India, which is among the top funds. And then again, next 50, they've done better than blue chips. They're all these large cap funds. So if you see all the yellow ones are index funds, the blue ones are actively managed funds. The green ones are the Sensex, which follow Sensex. Yellow ones are all which follow Nifty. So if you see Nifty has Nifty 50 and the other indexes have done really well. In fact, a lot of index funds have done even better than Mirai and ITI, Bank of India, and even Axis Blue Chip. These are the common funds, basic Nifty 50, and they have done better than some of the large cap mutual funds. So before we talk about index funds, let's understand conceptually what is an index. Now, some of you watching may be knowing this, but this is for the benefit of those who do not know, especially those who are not are new to investing, index funds, mutual funds, right? Index is basically a basket. Just consider it as a basket with, for example, different kinds of fruits. There could be orange, there could be a banana, there could be apple, there could be other fruits, oranges, all that. And each of those fruits which we have in that basket have different value. An apple may cost 50 rupees, an orange may cost 25 rupees, a chiku may cost 10 rupees, right? But all that put together, that basket is an index of fruits and it has a value. So all these put together, and you, for simplicity's sake, let's try to get an average. Maybe that average is 10 rupees. So that is the index. Now, same thing could be for vegetables. So each of those index, and what does that index tell you? What are the prices of fruits today? So it's, some are expensive, some are less expensive, but on an average, this basket costs all put together, all the fruits put together, probably it is 200. But 200 divided by 10 fruits, so it's 20 rupees. So average is 20. So if the apple prices go up, the average slightly goes up. If the orange prices go up, again, it slightly goes up. If apple prices fall, which is 50, it falls to 40, the index falls, right? You get the point? So there's a basket with all fruits, and the average is around 20 rupees. And each time any fruit price goes up, the index goes up. Each time any fruit, 2 or 3 fruit prices go up, it goes up. 2 or 3 fruit prices come down, the index comes down, right? So that is a basket. Let's take an example of CPI index. CPI index is used to calculate the inflation. Now, what does CPI index include? The CPI index basket has goods related to food, clothing, transportation, housing, electronics, apparels, education, medicine, etc. So CPI can be used to calculate the cost of living of the people of a country and also the changes in the purchasing power of the currency of a nation, right? So CPI index has a basket which has got all the goods and services, including our vegetables, tomatoes and onions, and other beverages. So if the prices of tomatoes goes up, onion goes up, potatoes goes up, for example, or some other goods and services goes up, the inflation goes up. So inflation is an index. Same way, now we're talking about the index in the stock market. Now, what is an index in a stock market? The two very commonly known or very commonly used indexes are BSE Sensex, which has got 30 stocks, and Nifty 50, which has got 50 stocks. So those are indexes. So they are a basket of securities. BSE has a basket of 30 securities. Nifty has a basket of 50 securities. So they have stocks. And we will look at what are the stocks these indexes have got. And these indexes actually tell if the market is going up or market is going down. They are actually an indicator of the economy of our country, right? It tells you if our country is doing well because the indexes are doing well, because the companies are doing well, because they're making profits. So this is Nifty 50, and these are the constituents, which means these are all the stocks, the shares, the companies that are a part of the 50 stocks in Nifty, that basket which I was talking about. This is a basket of 50 stocks. And what are the stocks? You've got Adani Enterprises, Apollo Hospitals, Asian Paints, Axis Bank, Bajaj Auto, Bajaj Finance, Finserv, Bharat Petroleum, Bharti Airtel, Britannia Industries, Cipla, Coal India, Divis Laboratories, Dr. Reddy's Laboratories, Aisha Motors, Grasim Industries, HCL Tech, HDFC Bank, Hero MotoCorp, Hindustan Unilever, Hindalco Industries, ICICI Bank, IndusInd Bank, Infosys, ITC, JSW Steel, Kotak Mahindra Bank, L&T, Mahindra and Mahindra, Maruti Suzuki, Adani Ports, NTPC, Oil and Natural Gas, Power Grid, Reliance Industries, SBI, Shriram Finance, Sun Pharma, Tata Consultancy, Tata Consumer Products, Tata Motors, Tata Steel, Tata Tech Mahindra, Titan Company, Ultratech Cement, Wipro, Nestle India, LTI Mindtree, SBI Life Insurance, and HDFC Life. Now, these are all the big companies, the large companies. And in this index, which is also called as the market capitalization index, Nifty 50, all these shares are not in equal proportion. The companies that are large, they have a larger representation in the market capitalization index. For example, Asian Paints may be a big company. So the market capitalization, the weightage in the index is large. But probably maybe some other small companies like Divis Labs may have a smaller representation in the Nifty 50. Now, let's take a look at BSE Sensex. So BSE Sensex has hit probably this is the highest, 82,000 today. And what are the constituents? Almost the same companies: Asian Paints, Axis Bank, Bajaj Finance, Finserv. Most of the companies are same. These are all the large companies which are stable companies. As I talked about, they are market leaders, they are global companies, they give dividend, they are stable companies. So these are these are the constituents, which means when you invest in an index fund, you get exposure to all these companies. You are a small co-owner in all these companies. How do you define an index fund? What is an index fund? If you have to invest in an index fund, what does it mean to you? How does it make sense? Let's understand. So an index fund is a type of a mutual fund that mimics the performance of a stock market index, such as Nifty 50 or BSE Sensex. Index funds invest in the same stocks as the index in the same proportions and are passively managed by fund managers. This means that index funds have lower fees and expenses than actively managed funds and are a good option for new investors. And another definition says an index fund is a type of a mutual fund that aims to replicate the performance of a specific stock market index. It works by investing in the same stocks in the same proportion as the index, providing broad market exposure to investors. Which means when you invest in an index fund, you get exposure to all these companies. And as these companies go up in the stock market or they go down, your fund also goes up and goes down exactly the same way. Now, in an actively managed fund, it doesn't work that way. If you had invested probably in a Nippon India large cap fund, it won't go exactly up like an index and go down like an index. Because in Nippon India, maybe Tata Motors, for example, has a higher proportion. There are more Tata Motors shares. And in the last 5 years, Tata Motors have really gone up. But Asian Paints has not gone up. So maybe they have less exposure to Asian Paints. But in an index, it is not like this. In index, there is a proportion. So Tata Motors is assigned this much proportion. Asian Paints also is assigned this much proportion. So if Tata Motors is taking up the index, Asian Paints may be bringing it down. But in this fund, because there is probably less exposure to Asian Paints or there is no Asian Paints, so what happens? Tata Motors takes it up. And that's why this active mutual funds may do better. But it can also work the other way. Just imagine one fund, maybe Axis Blue Chip, which is right now at the bottom, maybe has more Asian Paints and less of Tata Motors or no Tata Motors. But here, the index is going up because of Tata Motors and not going down so much, although it has got Asian Paints. But here in this fund, Asian Paints is dragging this fund down. So you see, an index fund is superior in that sense because it has got a basket of securities. Whereas this fund, an actively managed fund, does not have a basket of securities. It has few securities, probably may not have 30 securities, may have 15. And those 15, if they don't do well, your fund goes down. If they do well, they go up. But here, because this is a basket, it goes up and down exactly as the market. So it is far more stable. It may not give you great returns, but it will also not give you too bad returns. So what are the advantages of index funds? Number one, they are low fees. In an actively managed fund, even if the returns are not good, the fund managers will take a fee for managing because they are managing. Whereas in index fund, there is no fund manager because it is passively managed. You just have equal proportion. You ensure that it has got equal proportion and it performs just like the market. So you don't have to actively manage. You don't have to pay. So the fees are low. The expenses are low. And I just mentioned there is low volatility because the market has all kinds of industries, all kind of stocks. So it is stable. It doesn't go up too quickly, doesn't go down too quickly. It is stable. It's like a big truck. It'll or a bus. Definitely reach you to your destination. Maybe not as fast. So something similar. So here you've got an active fund which is far more volatile, and you don't have to track any performance here because they will be as good as the market. But here you have to track performance. Axis Mutual Fund was in the top in 2021, but today it is at the bottom. You have to track the performance. What if it continues to remain bottom? What you need to do is rebalance. You need to sell that and probably buy another mutual fund. Here you don't have to do rebalancing because it's following the market. So these are some of the advantages of large cap index funds. So what are the commonly known large cap indexes? So we can take a look at this. So if you see here at the top, you've got Nifty Next. Nifty Next mutual funds. These are the index funds which have done very well in the last 5 years and 3 year category. See the returns 24 and 23 and 24%. Now, these are the commonly sold index funds. These are the next 50. So Nifty 50 are the first 50 and Nifty next 50 are the next 50. Just to recall, large cap companies are the top 100 companies. The top 100 companies. And next 50 is the second half. Then again, you've got this next 50. Then you've got the common index funds are equal weight index funds. Now, equal weight index funds are exactly like the Nifty 50. The companies are the same, but the weightage is different. In Nifty 50, the weightage is based on the market capitalization. That means a big company will have a bigger representation in the market, bigger proportion. A smaller large cap company will have a smaller proportion. Whereas in a equal weighted large cap index, all the 50 companies will have equal weightage, which means if you look at 100% and these are 50, which means each of them will have a 2% share. That means if you invest 10,000 rupees, so 10,000 divided by 50, which is 200. That means 200 rupees of 200 will be assigned to one company. So HDFC, you'll get shares worth 200 rupees. Asian Paints, you'll get shares worth 200 rupees. Likewise, you will get each share because 50 shares, that is the equal weightage. But here, your 10,000 you will not get 200 rupees of HDFC. Probably you will get 300 or 400 and Divis Laboratories, you may get 100. So there is a difference here. Here, what happens in the market is that if here HDFC, which has got a higher weightage, goes down, your index falls down more. Compared to this, if HDFC falls down, but there are others which are going up, it adjusts. So here, the fall is greater or the rise is greater, but here there is more stability. And they have done well. And then you've got the Nifty 50 index funds. So Nifty 50 index funds, Nifty Next 50, Nifty equal weighted, and you also have some of the common ones are the BSC Sensex. Of course, there are many more index funds, but these are the commonly sold index funds. So if you have to purchase more for stability and for good returns, you can consider Nifty 50, Nifty Next 50, Nifty 50 equal weighted, or BSC Sensex. So let me share with you a quick analysis comparing index funds with stocks, that is directly investing, or the mutual funds, the large cap mutual funds, and also comparing it with FDs. So it is very interesting why and how index funds have given returns. Now, these companies are the 50 companies in Nifty 50 index. And if you had invested a lakh in these companies, what it would have become in 5 years. That means if you had invested in 2019, August, and today what would be? For example, 137 has become 3024. Of course, 1 lakh would have become 22 lakhs. But these are obviously exceptions. There is Tata Motors, which 1 lakh has become 9 lakh. But what about Nifty 50? Nifty and Sensex would have become around 2.5 lakhs, 2 lakh 18,000. But there are some direct stocks. For example, Wipro, IOC, ITC, TCS, these are all big companies. They would have given less than a Nifty index. IndusInd Bank would have given just 1 lakh. That's it, 1 lakh 2,000. Kotak Mahindra would have given 1 lakh 18. Not even beating FDs. For example, HDFC Life Insurance. HDFC Bank has barely beaten an FD. So, but at the same time, Nifty and Sensex, where you did not have to take any risk, you did not have to track, you did not have to do anything, just invest a lakh and you'd have given 2.26. Same way here, if you had invested a lakh in an index, momentum index, it would have given almost 2 lakhs. And how much would have an FD given in that same period? 1 lakh 21. And in 5 years, it would give 1 lakh 33. But if you see here, compare, these are all index funds. You didn't have to do anything. Low expenses. Just give your 1 lakh. And in 3 years, and in 5 years, just see, almost 3 lakhs. Almost 3 lakhs. This is purely index funds. So the beauty of these index funds is you don't have to do anything. Neither it requires a fund manager, nor a financial advisor or a mutual fund distributor who will track your funds. So if you want to directly invest, these are the funds. Of course, when you do direct investing, you don't know what is your risk profile, what is your time horizon, and all that, which a mutual fund advisor will help you with. But here, if you purely want to invest in an index fund and forget it, here are the index funds. They have given excellent returns. If you see, even some of the mutual funds, for example, Access Blue Chip has given less returns compared to some index funds. So again, investing in large caps is a no-brainer, and investing in index funds is absolutely a child's play. You don't really have to do anything. This is the beauty of these index funds. So now let's do a quick summary for this session, for this video. What have you understood? What have you got from this video? I started with the importance of large cap equities in your portfolio. Any age group, any risk profile, having large cap equities, whether it is direct investing, whether it is mutual funds or index funds, you must have in your portfolio. It should form part of your core portfolio, because equities are low volatile, less volatility, less risk, stable, good companies, dividend giving companies, market leaders in the country, and global exposure. Then I talked about why we should consider index funds. If all is good with large cap mutual funds, why index funds? And that is where I shared with you some news items where it is clear that not all mutual funds active mutual funds, where a fund manager is actively managing. Not all active managers are able to beat the benchmark. And what is the benchmark? Nifty 50, BSE Sensex. So because all are not able to beat, you can consider in investing in index funds. When I talked about what is an index, remember the basket of fruits, vegetables. Same way, the basket of securities, that is stocks, 30 stocks or 50 stocks. So that basket is the index. Then we talked about what are the commonly known indexes like Nifty 50 and BSE Sensex. Then I also shared with you the constituents, which means what are all those 30 shares in the BSE Sensex and what are all those 50 shares in the Nifty 50, right? So when you invest in an index fund, you get exposure to all these funds, all these securities. Then we also considered why invest in index funds. Because of their low fee, low volatility, you don't have to track performance and you don't have to do any rebalancing. No one has to watch your funds. They will keep growing. You just have to keep investing. Probably an SIP will be a best option if you're a salaried person. Then I also talked about what are the commonly known index funds. BSE Sensex Index Fund, Nifty 50 Index Funds, Nifty Next 50 Index Funds, and also Nifty Equal Weighted Index Funds. And we have already seen what kind of returns they have given. And then finally, I also shared with you some of the performances. Index funds compared with stocks. Yes, some of the stocks have given great returns, but there are at least 18 out of the 50 stocks have given less returns than the index. And then I also shared with you index funds compared with the mutual funds and also the FD, what kind of returns index funds have given. So what have you learned from this? Have you really understood the importance of index funds in your portfolio? Was I simple enough to explain to you? And if you are a wife watching this, I would like to know your comments. If you have understood what I've explained, do you think you will be able to invest if you were to in index funds? Was it simple enough? I'll be happy to know your comments. Please share your comments. I want to make these videos not for experts, not for those who already know investing, but those of you who do not know. I want to go to the basics. I want to help you understand the basic concepts. So if I've been able to help you with the concepts, please let me know. And if you like this video, please share a thumbs up. And if you have not subscribed, please consider subscribing and be a part of this channel. Thank you for watching this video till the end. Hope to see you soon.